Investors often face disappointment when their stock market gains do not match headline stories of massive returns. This can happen due to unrealistic expectations based on rumors, luck, or wishful thinking. To navigate this, it is crucial to set achievable goals and craft a personalized return target rather than relying on past performance or hearsay. This video guides you on how to create a solid investment plan and take control of your investment journey. Welcome to holisticinvestment.in. What should be the realistic expectation for equity returns? When managing your investment portfolio, whether it includes stocks, mutual funds, or a combination, it is vital to set realistic expectations for how much it can grow. Your financial goals are directly tied to these expected returns. To reach these goals, you must understand the concept of returns, which indicates the potential increase in your investments over time. However, pinpointing the exact return rate can be tricky. Many people simply pick a number based on what sounds good or what historical market performance suggests. For instance, some may aim for a return rate of 15% to 20% because it sounds appealing and aligns with past returns. Yet, relying solely on these optimistic figures can lead to challenges. Now, let's examine the rolling returns of Nifty 50 index over a 5-year period up to July 2023. Analyzing historical market data reveals that while there have been periods of 15% returns, there were also instances of negative returns, notably in March 2020 and throughout 2015 to 2020, totaling 5 years with negative returns. Moreover, there were many occasions where returns remained in single digits. When considering the entire index, it is notable that over 70% of the time, returns didn't meet the 15% threshold. This suggests that expecting consistent return between 15 to 20% may not always be realistic. Given this insight, it is important to explore other factors and metrics to form a more grounded expectation for returns. When considering equity returns expectation, it is wise to explore alternate methodologies beyond mere numerical projections. Here are 3 approaches worth considering. First, real returns. Former RBI Governor Raghuram Rajan discussed real returns in a lecture at the Tata Institute of Fundamental Research in 2016. Real returns are anything above retail inflation, with the goal being to achieve at least a 2% return above the inflation rate. To delve deeper, we need to assess inflation trends over recent years. For instance, the Consumer Price Index (CPI) has shown fluctuations in inflation rates from 2007 to 2023. When investing in less risky options like fixed deposit, a return of 7% might be considered fair, providing a 1.5% to 2 percentage point surplus over inflation. However, for riskier assets like equities, investors may target 4 to 5 percentage points above inflation as a fair return. Using inflation data for equity returns. Analyzing recent inflation figures such as March 2024 CPI at 5.2% suggests that a fair equity return should exceed this by at least 2%. For riskier equity investment, aiming for an additional 4 to 5% above inflation is common, leading to a reasonable expectation of around 10% return. It is crucial to understand that inflation is dynamic and influenced by various factors. Over longer periods and with compounding returns, equities could potentially yield around 12%. Considering inflation's fluctuation nature and the risk return profile associated with equity investments, by aligning expectation with inflation trends and risk tolerance, investors can make informed decisions about their financial goals. Next, equity risk premium. Imagine you have a money to invest and are deciding between government bond and stocks. Government bonds are low risk since governments rarely default, providing a guaranteed interest rate known as the risk-free rate. Stocks, however, are riskier due to market fluctuations based on company performance and economic factors. The extra return you expect from stocks compared to bonds is called the equity risk premium (ERP). During crises like 2008 or the COVID-19 pandemic, investors demanded higher premium for the added risk of stocks. Conversely, in stable markets, they accept lower premiums. The ERP helps gauge the potential extra return from stocks, aiding in setting return expectations. However, it is influenced by various factors and past trends may not repeat. Using a risk-free rate of 7% and an ERP of 4.2%, the expected equity return is 11.2%. This historical average indicates a 11% return, factoring in the risk premium over government bonds. Yet, actual returns can vary based on economic conditions and investor sentiment, with higher premiums sought during downturns and lower premium during upswings, balancing out long-term returns around 11 to 12%. Next, nominal GDP growth and stock market returns. Nominal GDP growth serves as a dependable indicator, merging real GDP growth and inflation to showcase overall economic expansion. Analyzing 5-year periods reveal a correlation between nominal GDP growth and stock market returns. When the economy grows, the stock market typically follows suit. However, there are exceptions like the stock market crash in March 2020 despite the economy's stability at that time. On average, nominal GDP grows by approximately 10.7%, paralleled by stock market growth of around 12 to 12.2%. Higher returns are possible with increased risk tolerance, but economic downturns may impact investment expectations. Using nominal GDP growth as a benchmark can guide return expectations, with any excess return seen as bonuses. During economic downturns, adjusting expectations slightly higher may be prudent. Simplifying calculations, monitoring nominal GDP growth can provide a straightforward gauge for investment outlooks. Next, what equity returns to expect in the upcoming years? The projected nominal GDP growth for 2023-24 is 9.1%, a decrease from the previous year's 14.2%. Historical trends suggest that equity returns typically surpass nominal GDP growth by 2 to 3%, which is expected to continue in the upcoming years. However, the COVID period and its aftermath may be seen as outliers due to significant economic contraction and the subsequent rapid recoveries. It is crucial to recognize that nominal GDP projections are subject to change and influenced by various external factors. Therefore, while using nominal GDP as a reference for equity returns expectation, one must remain aware of potential economic fluctuation and uncertainties. In conclusion, it is important to set realistic return expectation around 10 to 12% rather than aiming for exceptionally high returns like 15 or 20%. If falling short of financial goals, focus on increasing savings instead of solely relying on boosting returns. Before making investment decisions, understand the inherent risk associated with the stock market investment. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.